Hey everyone, Dustin.Bates here. I'm a commercial real estate agent specializing in multifamily and net lease properties. We're just getting started here. Give us a moment if you see any dead space with the audio. We're just checking our various platforms, making sure everything's live and we're good to go. And if you do put a comment in and we may not see it, there's multiple platforms that we're streaming to right now. So just bear with us. If we see a comment, we'll go ahead and respond to that in the next day or two if we don't get to you here. Again, I'm Dustin.Bates. I do commercial real estate. I've been a commercial real estate agent for about 12 years now. I do multifamily and net lease properties. And I brought on Katelen here, who's with Kingsbarn Capital, who is a specialist with DSTs, which is a fantastic way for an investor to trade into or exchange into assets that maybe they do not need to control. They don't want a lot of control over or management of. Works very well as what I call a safety blanket for an exchange. If you are working on stuff, you could back into or use these as a backup as well. So Katelen, why don't you take it away and tell us about your company?
Sure. Happy to be here, Dusty, and welcome everyone. As Dusty mentioned, I'm with Kingsbarn Real Estate Capital. I am the VP of Central California, and I work with a couple of different alternative investments. We're going to chat about, as Dusty mentioned, the DST today, which if you don't know what that stands for, don't be afraid. We're going to go pretty in depth on it. It stands for the Delaware Statutory Trust. We have a couple of different opportunities that I'll talk about at the end, but primary focus is going to be on utilizing that DST as a 1031 exchange alternative. I've been with Kingsbarn for almost 2 years. Prior to that, I worked in a little bit of residential property, but really my background was I clerked in civil litigation on the legal end of things. So I bring that perspective in kind of to my real estate investments for my clients. So without further ado, here we go. So who is Kingsbarn? Kingsbarn in the DST sponsor space, we've been around since about 2011, which is pretty much analogous to most of your other sponsors because that's when the DST boom really just started to exponentially grow. We have about 100 years of combined real estate experience across our executive team, and we dabbled in syndication, tenant in common assets. We have development, tons of knowledge and background in that area, and then we've really just taken a big market share of the space in the DSTs, and it's a really great fit for a lot of investors. So what we do, we actually identify and acquire all the properties. We secure all the non-recourse financing on the properties, all of the organizational and offering documentation to set these up as a DST. There's legal tax opinions provided, all of the closing activities and qualified intermediaries. If you're not familiar with that process, that's okay. I'll touch on it a little bit later. We're also providing the continuous professional property management and asset management on the properties. And then we're also overseeing all of your monthly operating reports and distributions. So yes, you do get paid on these and they come out in monthly distributions. So
now, if I may real quick.
Sure.
So if you're watching this and maybe this is using the 1031 exchange. This is a way to exchange for the most part, right? In something. So if you're not really well versed in exchanges, we also have another class that we'll teach that goes all over 1031 exchanges. So just if you're a little bit lost with that part of it, don't worry. We'll do a class on that as well if you haven't already seen it. So just want to make sure we pointed that out.
Yes, absolutely. And you'll have Dusty's class, and then you'll have my contact information here at the end too. If you ever have any questions, I'm happy to help educate. Like I said, that's what I deal with mostly on a daily basis. Also, note, these DSTs we're going to focus more on the simplified exchange solution that they provide, but they are not only available as an exchange solution. They are available for direct investment. So please keep that in mind. If you're trying to diversify your portfolio, these work very well for that as well. So Again, we've done about 51 fractional programs, fractional meaning the DST programs. We're in actually 30 states now, not 26. We've got about $1 billion in managed assets. And then the average cash on cash return to investors is about 6.29%. But I've sold actually in the pandemic, we had things as high as, 8%. So hoping that those will come back again soon. So
the markets, man, that is a really good concern right now.
It is. And a lot of my properties are still in the 6.5, 7 range on some of them. So just depending on asset class, which I can talk about a little bit later. Again, if you're not familiar with the 1031 exchanges, that's okay. We can clarify that later. And as Dusty said, he's going to have some additional material on that. But one of the benefits here is in a 1031, you can exchange into a higher value property, right? The same is true with the DST. If maybe you're coming out of a triplex or you're coming out of a smaller office property and you're really looking to get into, some great single tenant asset that's a large medical building, or you're looking for a large piece of the pie in an industrial building, but you yourself don't have $50 million to go purchase that, the DSTs can assist you in diversifying into a really high value property without having to be the fee simple owner with $50 million, right? So it's some little examples here on the screen. Obviously, trading into a higher class asset is the goal, right? So
Now, if I say have $1 million out of my office building that I sold, and I exchange into like a fractional interest in like a $50 million building that you guys are offering, as far as depreciation goes, do I get a 1-for-1 there, or are you guys leveraging up and I get a portion? Maybe I get to leverage up a little bit. How does all that work?
It's going to be the latter. It'll be the latter. So you will receive your portion of the depreciation on the property. What we do at the end of the year is whatever your equity portion is, which would be like you in your example, the $1 million, what you put in, then you'll be assigned your pro rata portion of the non-recourse debt. Don't let that scare anybody, but you'll have a total portfolio. And then at the end of the year, we compile a tax package that we send over to your CPA, which will include all of your income, obviously, and your share of the depreciation. And then we also provide, you've also got, if they don't do away with it, right, they're trying to, but your accelerated depreciation. So we put cost segregation studies on all these properties. So there is a possibility. There's a possibility that your CPA can massage those and get you some additional accelerated depreciation on top of.
So, sorry, the sidebar, but I hear that Tax and Jobs Act of 2017, if I'm right, that expires at the end of the year.
It does, yes. So if you, I've been telling my clients since last year, if you are looking to take advantage of that, I would highly suggest, if anything's going to be on the chopping block, I would forecast that that's it. So if they don't renew that, you want to get in this year if you need it.
Okay. And by the way, anyone watching this, we also have a class on that coming up as well, on accelerated depreciation and depreciation.
So, the DSTs here, again, with the 1031 exchanges, for those of you familiar and those not, quickly. When you sell your property, you then have 45 days to identify your replacement property. After that time, whatever you've identified then has to close within 180 days to defer your capital gains. So those are extremely short. And that is extremely difficult to do in a market like today, especially if you are identifying properties that, you've got 45 days to ID, but you don't necessarily have the due diligence. You haven't even, you've got to go into contract and really get into those. 45 days is a pretty short time frame for a commercial property to get in. And if you've identified 3 properties and you get into the nitty gritty and something, they just don't look as appealing as they once were, you're stuck. It's either go forwards with those properties or pay the gains, which we don't want you to do that. And then again, you also may have some difficulty if you're trying to leverage up and you've got financing in there. you make it past your 45 days, you're still interested in those properties, but now you've got the financing debacle to kind of work with. So that 180 days it seems long when you just look at it, but it can become very short. The DSTs are a really great option here. I'm going to focus on this for a second, just because we have the screen up. You are looking at assets where you do not have to go into contract prior to getting all of the due diligence, prior to vetting these properties. You get all of that information up front because Kingsbarn already owns these property, or the sponsor owns the property that you're looking at. So you have all of that information up front, well before your 45 days may even start. So you've really got a leg up there. And then you don't have to wait the full 180 days, which also means you are getting income. You're not waiting 180 days to then close on a property while you're sitting there making no money. So a very large perk of the DST. So without further ado, what the heck is it? So a DST stands for Delaware Statutory Trust. The reason is it's incorporated in Delaware. If you know anything about Delaware on the legal side, they're very business friendly, which is where they come up. It operates just as its name implies. It's a trust. So if you are familiar with, if you've got a living trust, perhaps for estate planning purposes of that nature, it functions very, very similarly. And what we do is the DST holds the real property, any property related securities for investment. And that would include, like our $1 million example, a fractional investment in a larger property. So the property itself is thrown into a trust formation. Okay. So some people will say, oh, how am I actually invested in that singular property? Or is this a pooled fund of money and then you're going out and buying whatever properties? If it were the latter, it wouldn't work as a replacement, right? Because we have to replace like-kind property. So you are actually investing in the properties you see. When you identify a DST, you are identifying a particular address, which is why in the tax code, it qualifies as a like-kind replacement property. So DSTs allow accredited investors to own fractional interests in institutional properties. That's a lot of jargon for, what does that mean? So an accredited investor, I've got a slide, we'll talk about that, but an accredited investor is anyone who has $1 million in net worth. There are different ways to qualify that. You do have to exclude your primary residence. But you can use, if you've got Fidelity mutual funds or things like that, there are ways to get there. You also can qualify if you have $200,000 in income per year for the past 2 years, or $300,000 with a spouse or partner. So with property, it's pretty easy to do. If you're not there, we can always help, create a plan to hopefully get you there one day. But these DSTs, you do have to be accredited for. So as I mentioned, the investment in the DST is considered a replacement property. It is actually codified in the tax code. This is not experimental. So it satisfies the like-kind replacement property. So you can find some encouragement there and confidence. And then each investor, what do you own? So I've got $1 million and I want to purchase into, Kingsbarn has a medical plaza. And we purchased a building for $50 million and we put it into a DST. And now I want to own my $1 million portion. I would place my $1 million in, and now I own my beneficial interest in the property. I am actually a beneficial owner of the property that is KB Medical Plaza. Okay. So you come with a percentage of the share, which also means I get my percentage of the cash on cash return that is projected, so that your NOI, your cash flow that's coming off the property, as well as the depreciation we talked about earlier. So really, it's very, very similar to a traditional exchange or ownership in property. However, you are not the fee simple owner. So it's more of a passive investment for you, and it is very passive. So essentially you plug your money in and you get your cash flow every month, but you're not having to manage the property itself. You're not trying to manage. Do what?
You don't manage the property. It's usually these larger, tends to be a larger asset like that.
Mm-hmm.
You guys hand deliver all the tax information to their accountants.
Correct.
Just buy it and forget. Do they also get, you buy it for $50 million, or it's a $50 million property, it sells for 55? How does that $5 million split up?
Sure. So there are some legal ramifications, obviously, with the trust, right? So this isn't just kind of a plug and play flip on Kingsbarn's end, right? There are some additional fiduciary duties that come along with the DST, which is a little more confidence to, it's encouraging to investors because there's another layer there, right? So that means that all of the appreciation on the property on the back end, that goes to the investors. So also any unused reserves. So these properties, the way they're structured legally, you cannot do any type of additional capital call on the property. So with that in mind, Kingsbarn places about $3 to $4 million, depending on the property. They're in reserves to mitigate any, vacancy that might occur or any unexpected TI, things of that nature, right? If there are any unused reserves at the end, which has happened, those will go back to the investors as well. So there's quite a bit of upside when you take that into consideration, in my opinion.
Great.
So not only are you getting your cash flow, you're also getting the benefit of the appreciation on the back end when the sale occurs, right? So the DSTs, again, these are pre-vetted properties. Kingsbarn is going and acquiring these properties specifically for the strategy of placing them in a DST. We're also placing the financing on them. So in lieu of you as an investor, especially in an exchange, if you're trying to exchange your entire portfolio size, right, and you had some debt replacement, if you had some loans, you've got to replace the total portfolio size. So you have the additional struggle of finding financing to then defer all your capital gains, right? So on this end, the DST, Kingsbarn's already secured the financing on these properties. So on paper, when you come in, you get your pro rata portion on paper of the non-recourse debt, right? So to the IRS, it looks like you've satisfied your financing and you have now deferred all capital gains. But that financing is non-recourse to you, which means it's not showing up on your books. And you also, should a default ever occur, knock on wood, has never happened, obviously, your creditors, you're shielded. The creditors cannot go after you. That's the whole meaning of non-recourse financing. So it's really a win-win. You're not trying to jump through hoops to try and finance some building and then hope that the building was the one that you wanted for replacement in the first place. So
and that's even more headaches off the plate too, with the financing and all that.
Exactly.
Wow.
Plus, as buyers and as a company, we're buying these large assets. We have these off-market relationships and lenders. It's easier for us to maybe get better financing than you would as an individual, even if you've got some dough to play with, right? Because we've got the ability to buy down these interest rates and things like that. So we're probably going to get better financing than you in the first place. So also, as I mentioned, if you look at these DSTs, they're already pre-vetted. You came to me and I've got my $1 million and you want to look at what you want to go into. The hardest part of the process is just selecting which property you like. You're vetting that just as you would any regular property. And once you've selected, for the most part, you can close in a week. I've had people close in as soon as 4 days, honestly. So, that's a huge change for investors who are used to waiting long periods of time. And again, that's less time that you you're making money, right? So if you close quicker, the faster you're going to get those distributions. So that's great. Obviously, flexibility in the equity amounts. If you come in with $250,000, or if you come in with your total exchange, I've done exchanges as large as $20 million, diversified across a couple of DSTs. You're not limited to one DST. You can diversify further and go into multiple. So it's very flexible in that respect. Also, as you mentioned, they're utilized sometimes as a backup strategy. So maybe you have, 2 or 3 properties that's kind of your plan A that you really like, but you're not sure. And they will identify a DST as a backup. That used to be really prevalent. I personally would not, I wouldn't rely on that as your plan A, that you're going to use it as a backup, just because the equity, so many people are gaining steam with these and really, really invested in these. The equity goes extremely quickly. So we have done about 145 million to date this year in them. So more and more people are becoming aware of them and more are coming in. However, that said, it is not inconceivable to utilize it as a 1031 backup. I would just work with you personally and really manage those timelines correctly. And then
you did 145 million this year so far?
We have, yes. And we have another.
So if you're watching this after the fact, and this is a recording, we just ended the first quarter of the year.
Yes. Great. And we have another, I think it's 66 million in the pipeline of people waiting. So yeah, that's my little caveat to the 1031 strategy there. I'm always pretty cautious. Obviously, it came from the legal side. So we just want to really make sure when you're doing those nominations, because of how strict they are, that we would work closely on your timelines if that's what you're trying to do, And then last but not least, we coordinate the entire closing process. So we try to make this as easy breezy as possible for the investor. So when you come to me with that $1 million or 250,000 or whatever it is, once you've selected the property, I take in a couple of intake forms, how you held title on the property, where you want your money to go every month, who your accommodator is. If you don't have a qualified intermediary, I can help you with one. Basically, I send that off. My closing team will then coordinate with the accommodator and make sure that all your exchange docs and everything are done. You're obviously CC'd on all the communication, and then they send a wire. So it's very quick and as painless as possible for you. And if you don't just have to be an individual, obviously, to utilize these DSTs, you can be an LLC, you can be a corporation, you can, joint tenant, whatever the entity may be, you can still utilize the DST. So back to, here you go, a little bit about DSTs just in general. You can see the exponential growth here from 2015 to 2021. I mean, last year across the board, all of the sponsors, and there's about 44 of them in total, did 7.4 billion last year. And I imagine that will only probably grow again this year, probably double if I had to guess. Just a little tidbit: Kingsbarn is a top 10 sponsor. So we have done well in the game and we do well by our clients. So again, the benefits of the DST to you as an investor: you're deferring your capital gains tax, right? If you're utilizing the exchange, you've got the ease of the 1031 timelines. Those aren't, such a big hurdle anymore for you. It's true passive income because, as I mentioned, we're managing the asset. You're plugging your equity in, you get your check every month. And then on the end, obviously, we're making you aware of, hey, giving you time to let you know, we're going to dispose of the asset. Here's what the appreciation is likely going to be, and giving you options on where you're going to go next. Obviously, the depreciation, you've got a pretty predictable cash flow. Obviously, these are investments. It's just like regular property. You can't guarantee, 10 years out what the cash flow is going to look like. However, we've done a really good job. Again, knock on wood, we have actually always been able to provide what we've projected, and actually outperformed some of them. We tend to be more conservative, so under promise, overperform. So, yeah.
And you said as far as, because you're obviously moving in and out of these assets, you get plenty, plenty of time, like, because they're going to have to exchange again if you sell it.
Right.
What kind of timelines do you do, when you decide to offload an asset?
Sure. So, and I'll touch on this again on the exit slide, but, these are larger assets, right? So, these are anywhere from, call it 25 to 60, $80 million assets. So it's going to take probably 6 months to a year to affect a disposition on them. So
okay.
we're trying to give, absolutely as much time as possible to the investors. So once we've entertained an offer and gone into contract and we're in that due diligence phase, we are letting our investors know, hey, this is what the timeline is looking like, so that they can then start to think about what their strategy is going to be next. I'll say it again, but for now on the exit, you are going to have the option to 1031 into another DST. You can roll it over, you can cash out. Probably don't cash out. Or you can 1031 back into a regular property. I kind of like to say, hey, if you want your tenants' taxes and toilets again, absolutely, you can do that with the DST. So if you decide that it's not for you, I will tell you that like 98% of our investors just continue to roll them over. Once you get in and see how easy it is, most people just continue to do it.
Great.
Yeah. So one more thing that I like to hit on is the estate planning advantage of the DST. So again, it's set up as a trust, right? So you are the beneficial owner of KB Medical Plaza. Now, let's say you've lived a very full life and you meet your demise during your tenure in one of these DSTs. Your heirs then will take over and have the ability to do exactly as you would on the exit. So they can cash out, they can 1031 into the next DST, or they can 1031 into another fee simple asset. Now they're also going to help eliminate estate tax ramifications, right? So the DST allows the step up in basis to the heirs as the current tax law stands. I know there's been some talk of doing away with that. However, I'm not sure of the likelihood policy-wise that will pass, but as it stands now, you that's available to you with the DST. It's also a really great way. I've had a lot of generational wealth come into these, and they have children who may or may not. Children or whoever the heir is, they may or may not want to manage a real estate portfolio. They're not wanting to do active management. They enjoy this passive cash flow. And so the beneficial owners that, are setting up those heirs to continue receiving that passive income, but still having the strength of real estate behind it with real estate professionals who are managing it. So that's a really good,
I've actually had a lot of my business has been owners who perhaps, built a multifamily portfolio over their career, and they know how to run it, but their heirs absolutely do not. And so that's a big concern is, how do I pass this, what I've built onto my heirs? And this is a great solution for that.
Absolutely. A stellar solution. Or I've had some, gentlemen who their wives are, marketing professionals or whatever have you. And it's kind of the same situation. They want to be able to make sure that they're not then bombarded should they pass with this day-to-day management load on these properties. And not that they're not fully capable. It's just they want to make sure that whoever it's being passed to is set up with a nice income and something that they're not having to manage day-to-day. Time is money. So those are some just really great perks I like to hit on. Again, back to who can invest in these. So accredited investors, again, I mentioned it's a net worth of $1 million, excluding the primary residence, multiple ways to do that. And then individuals' income exceeding $200,000 in cash last 2 years, or $300,000 jointly with a spouse or a partner. And here is the DST exit. So just a nice little visual for you. Again, you're going to have the option. So going back to our medical example, it is 7 years into this DST, and we have a wonderful buyer in place who's going to give us buku appreciation. And so we take the offer and we're proceeding down the route, and it is going to go through. You now are, as an investor, we're going to give you as much notice as possible. This is not something where we're going to give you 45 days notice on. Okay. You're going to have a couple months of notice to get your eggs in a row. And also we want to make sure that, you're a repeat investor, that if you are looking to roll over with us, that we're placing you and giving you a good opportunity to look at what our upcoming properties are. Like I said, they are going very quickly, but we want to give you, obviously, first option at the best ones if we can, because you've already invested with us. So we're trying to give you as much time as possible. Now it is a property sale, so there's going to be some flexibility in there. You're going to have to ride that out, but for the most part, we just had a large full cycle deal come out, and those investors were happy with the process, and we placed them into new properties that we had. Most of them rolled right over. So I think about like 97.5% of them did. Don't quote me on that, but that was the numbers that I got. And they did receive appreciation, and they did receive their full investment back. So again, these are your options. You can roll over. You can go back into a 1031, or you can cash out. Don't do the third option, especially not with inflation as it is. And
yes, please talk to your CPA so they can tell you.
Yes. Yes. I always, please know, I work with CPAs and tax attorneys all the time. If you have any questions, I always defer to my CPA. I'm an attorney as well. You want to see, make sure that you're getting sound advice, right? I don't think cashing out is ever the option personally, but here's a great example. You mentioned the multifamily being set up. So we had an investor, she's actually going to she had 10 more properties to do. She had a very large portfolio that she built with her husband. Her husband passed on, and she was managing all of these properties in Southern California by herself. She is in her 80s now, and she was literally working 7 days a week trying to manage all of these properties. This first slew of them was about $14 million. And so what we did is we diversified her, as you can see, across there are 6 different property interests here that she was diversified across. And we increased her cash flow, and she doesn't have to work 7 days a week. She this is just all path of money for her. So it ended up being a really great deal for her. And again, like I said, so much so that she is reinvesting with us. So
finding it harder and harder to compete with you as you go on, just so you know. Maybe I have to send everyone your way.
Yes. Well, you know what? It depends on what the client strategy is. I'm always very, very upfront about that. This is no one needs to be hoodwinked. You need to feel sure, but I'm telling you, most of the time, once people get in here and see it, it becomes the plan A for pretty much everybody, because it's just really easy, especially in a market like today. Nobody wants to be a buyer in this market. Again, really, really close timelines for closing right here. You can say from presentation to deal closed 8 days. I've had them, like I said, the closest I've had one was 4 days. So, if you can get me all the paperwork, lickety split, and we're already ready to rock and roll on that property and it's available, we can close very quickly. Here are some samples of properties. These are all already filled or closed. And people sometimes, what does that mean? So when we bring out a property, let me show you like a property like this, Sprouts in Jacksonville. We close on the property, and then we offer up the investment portion of equity. So let's say I can actually show you what it is. So the equity offering here, the total investment, right? The purchase price here, $35.2 million. The equity offering up in the top here is going to be the $17.8 million. Now, the $17.8 million is the equity that is available for you to invest in on a fractional basis. You could take $10 million, you could take $150,000, you could take $1 million. whatever it may be, that's where your chunk of the money is going. Okay. So when I say that an offering is open, that's what I'm referring to, that equity is open. When I say it's closed, that means that the entire equity offering has been filled and that property is now closed and just in its hold period. It goes very quickly. I have had some of them go in a week. So these are not property.
Just to repeat, this is not like you guys have it in contract and you want to put you guys have closed, you own it, and then you're going to replace yourself with the investors as they come through.
Correct. Yep. So this isn't like a capital raise and then we purchase the property. The property is already purchased, the financing is already in place. And again, like you said, yep, we're just replacing ourselves with the equity offering from fractional owners.
Perfect.
Now, each property is going to differ in its financials, because we like to say that we're a little contrarian. This isn't just a lot of other sponsors are really more of just a syndicator. They plug in their numbers, Argus, and then they pump out a return, and that's what they offer. Most of ours are generally going to be more real estate minded. We're going and looking for Class A assets in out of favor markets in maybe a tertiary market, like Jacksonville is large. We do have properties in LA or Anaheim or El Segundo, or we have properties, in Texas, in Arizona, Nevada. But we're looking at them as a real estate investor standpoint because we know going in already that we have an exit strategy in mind. And that's something I didn't touch on, by the way. When you place a DST together and you put leverage on it, the tax man wants their money somehow, some way. People are like, these are great. Why aren't you holding for 50 years, right? So at some point, IRS wants their money. They say that legally, if you place any leverage on a DST property, it can only exist in a DST structure for the life of the loan. Generally, our properties, for cash flow purposes and financing, what we're able to do, we do a 10-year mezzanine loan. So that means that going in, we know that at year 10, we now have to sell the property. No, we cannot just refinance the property. You actually have to change hands there. There are some caveats. If you want to get into that, you can ask me questions later. I can tell you the emergency exit routes, but we've never had to utilize them. But 10 years in, typical hold strategy is 5 to 7 years, right? So when we pick up these properties, we already have those timelines in mind. And then, like I said, the financials are going to change on every property. It's not just a set fixed rate that you see for all the properties. So like, for instance, this one here is projected first year cash flow at 6%. You can see that the loan term is 84 months actually. And then there's an interest only period of 48. You may see an interest only for a term of 120 months. It just depends on the property. But we pride ourselves on being extremely transparent. So you get to see exactly what the estimated use of proceeds are. You see exactly how much money we make. You see exactly how much leverage, what the leasing, everything, what that looks like to you. We're not afraid to show you that. It's your money. So if someone else is not showing you those things, run.
Yeah, that's good.
Yeah, run. This should be very transparent. This is, again, just an example of property. We really have enjoyed the fleet farms. Many of you are probably like, what the heck is a fleet farm? I call it the Costco of the Midwest. They were a family-owned business for, I think, 63 years, somewhere ballpark around there. And then they were picked up by KKR, a large private equity firm. Obviously, you can see they're on the New York Stock Exchange, et cetera. This particular property had 22 years remaining on a triple net lease. Very similar to those of you on the West Coast with, Costco. They've got the setup of the warehouse. Some of them have a little bit of industrial space. They've got a car wash, an auto service, tire center, et cetera. We've picked up quite a few of these. I have another coming online next month, or this month, excuse me. And 3 more behind it. So we've found a lot of strength in these, and clients have really enjoyed them. This is another, just to show you a different asset class. This is a multi-tenant office down in Anaheim. Now, people see office still, and they're like, oh my goodness, I'm going to run away at lightning speed. If I can provide you any confidence in a story for you, it would be this. Kingsbarn, in all of the pandemic, sold primarily multi-tenant Class A office. And at 7, my average was 7 to 8% cash on cash returns. And these assets are actually outperforming original cash on cash projections. These are
what you acquired, or what you guys were acquiring?
So we acquired and closed. I think there were five of them last year that are all multi-tenant office. Very, very happy investors, with those cash flows. And then, long lease terms, you've got some diversity when you've got, multi-tenant office. Obviously, there's a different strategy there with vacancy and how you're dealing with that. But most of these buildings, these aren't, a Class C building, in some tiny market that has 10,000 people in it, right? These are larger assets. Generally, they've just been renovated. They're very aesthetically pleasing buildings. People want to be a part of these buildings, and many of them are sound tenants. They're made up of, we used to say recession-proof, but let's say pandemic-proof, right? Our people in office never left, and/or we increased occupancy. So people are always like, well, what's your guarantee? I'm like, Kingsbarn placed... We had 100% collection of rent in our Class A multi-tenant office properties during the pandemic, and we increased occupancy in them. So if that's not a win, I don't know what it is.
So you're like, if you're new to this, like, you don't get a personal guarantee from Kingsbarn. It's guaranteed by the property. And you guys have a track record that's very, very attractive. That's probably what you would point to. Is like, well, here's what we've done historically. Right?
Absolutely. And granted, there's always the caveat, like I said in the very beginning, and again, I'll say it. These are investments. This is just like if you were going into property too. There's always a risk involved. If you're looking for 100% guaranteed return, real estate is not for you. But I know that most of our viewers here are sophisticated enough to know that. And again, like you mentioned, pointing to our track record, we've done really, really well for ourselves, and we pride ourselves on our past real estate experience as well. We know that these assets are probably going to perform extremely well. It's why we picked them up. And if they don't do well, it doesn't do well for our investors. It doesn't do well for us. So we're in this symbiotic relationship together. Again, you can see on this building, the Stadium Crossings, which is full. It just had a recent renovation. Those Waukee Fleet Farms that I showed you, many of those are new builds. That Waukee Fleet Farm, I think, was a 2020 build. The one I'm bringing on is a 2019 build. So these are really nice properties in good locations. So like, for instance, this Tangent, this is an industrial property. This is got, speaks for itself. It's got Amazon, it's got Iron Mountain in it. As far as safe DSTs go, I'd go here by far. A little bit lower of a cash on cash return at 5.75% originally, but it's an industrial building outside of Portland with, like I said, Amazon, Iron Mountain, HP. Extremely strong quality of tenants. Location wise, obviously, we're looking at things that are right there off of major corridors and things like that. So now let's see what questions maybe I would say the questions that I run into the most. I don't know, Dusty, if you have some already ready for you. If you don't, I'll go into my FAQs that I get asked after hearing all of this.
Yeah, please do.
Sure. So one of the main things I hear all the time is, you know what, that was so great, it's got to be too good to be true. What's the catch? Well, like I said, we're extremely transparent. There's not really a catch, but I will delve into, people ask about liquidity. And what does it look like trying to get out of a DST? Once I've gone in, what's the process there? So I like to tell investors, especially if you're coming in on an exchange, your exchange always follows the sale of the property. When you're utilizing a DST, you're using that just as you would a regular fee simple property, right? So if you exchange in, you can only exchange out once the property is sold. So when you go into a DST, you go in with the knowledge that you're going to hold in that property for as long as Kingsbarn keeps it. So you're not going to be able to exchange out of that until the property is sold. And like I said, it could be 10 years, it could be 5 years, it could be 7 years. Some people are a little concerned with that, but really it gets down to, well, what was your exit going to be on a traditional property, right? You weren't just going to sell a property in 3 years just to sell it. You're trying to make as, much appreciation as you can on the property, being smart. Where are you going to move it? What are you going to exchange into? The same is true of the DST, right? It's just a larger asset. So we're managing that stress or struggle for you. We're making sure that we're selling at top dollar if we can, or extremely strong offers, and managing the market, looking at the forecast. We're actively doing all of that for you. So if that's really your main concern, we're taking care of it. And like I said, it could be 5 years, it could be 7 years. Obviously, that stipulation, no more than whatever the life of the loan is on the property. But if you're looking to bounce into a property for a year and bounce out, the DST is not a good solution for that. Because like I said, you need to go in with the mindset that you're going to hold for that entirety of the holding period. Now, liquidity wise, what happens if I go in and I want to pull out some money? So you can borrow against your DST interest. I have had a client do that. I have a broker who specializes in that, who I refer out. So I generally say, you're not looking to pull out the entirety of your investment and then just borrow on it. I personally think the interest rates are a little too high to do that, but it is feasible. If your numbers make sense, you go to your CPA and tax attorney and go over that with them. Maybe they may advise you otherwise, but it is possible to do. And the other thing is, what happens if I have to get out, and Dusty, you say, hey, Katelen, I need that $1 million out. Do you want to buy me out of my equity position in this property? As long as you're an accredited investor, it's got to be approved by Kingsbarn. There's technically no restriction against assignment on these properties. So like I said, as long as you're an accredited investor, and Kingsbarn has approved it, I say, yes, Dusty, I will buy your $1 million share of Tangent Logistics here. Now, keep in mind, you're going to trigger a taxable event for yourself, though, because now you're going to get hit with gains.
Right. So you can't exchange, but you could get paid out.
Yeah,
you're not exchanging, right?
And you technically could. And there's not really a secondary market for these. There is a firm who does some of them, but again, you're triggering pretty large consequences for yourself. You're going to pay them some type of fee. You're going to then also the tax implications of the money that you're taking out. So I go in saying they're not real liquid. Okay. You're going to hold in the property. And this is more of a long-term strategy for yourself. The other,
who, a lot of times they're like, well, do I exchange or not? And I have them, I do a lot of fast food, but we'll exchange into like a Taco Bell, and then they'll leverage out whatever money they wanted. They'll pull out $1 million or so. Are you saying you can do this as well with a DST?
So you can, like I mentioned, you can pull out up to, and I believe it just changed, so don't quote me on this, and I can double check again, but you could borrow up to 50%. You could leverage against 50% of your DST investment. And you can keep that money out. But again, you're going to incur whatever the interest rates are on that. I haven't had any clients who've done that personally. That we have had one with a firm who pulled it out for a short influx of cash flow they needed because they were doing a JV, joint venture, and then they pumped the money right back in. So they didn't keep it out, for 5 years. They kept it out for a couple months and then plugged it back in. So, but again, I talk about different scenarios with clients all the time. And, if that makes sense with your CPA and you get your professionals involved, like I said, as long as you're an accredited investor and Kingsbarn will allow you to transfer that by vetting, the investor, not to say that it couldn't be done.
Right.
Yes. So do you have any other questions for me? That's probably one of the biggest that I get.
I think we've covered a lot of what people,
Yes.
as long as they know what an exchange is and how those rules work. Hopefully they get their head around the depreciation idea, because that's fantastic that you guys do that brain damage and just hand them a package at the end of the year. That's amazing.
The other thing to point out too is now it's ordinary income that's coming off of these properties versus, a higher tax bracket for, dividends can sometimes be taxed at a higher rate. Now, granted, defer to your tax specialist, of course, but a lot of times that ordinary income ends up helping people coupled with the depreciation more so than going out into, a stock and getting a dividend that's taxed at a higher rate. Obviously that depends on your personal portfolio, but something to keep in mind. So yes.
Yeah. Great.
I have one other thing that I'd like to touch on just really quickly. What about our owners who love all of the passive application of these DSTs, but maybe they would like to have a little bit in DSTs, and maybe they still want, a passive managed, more fee simple asset. And some would say, well, why wouldn't they just go pick up an asset and put property management on it? You still have to go find it, finance it, go through all the rigmarole of putting the property together, right? We have investors who have come in with larger equity portions who would like to be more of a fee simple owner. They want control, a little more liquidity, but they want all the perks of the DST. They want the non-recourse financing. They want, the ease of going through our Rolodex of assets that we have available and/or utilizing our buying power, and then really just getting a check every month. And then they'll diversify and pump a little bit into the DSTs as well. So really a diverse portfolio. We do have what's called the Managed Direct Ownership Program. And managed direct ownership is exactly what I just described for larger owners who maybe, they're not scared of leveraging up. They've got, $6 million in equity that they want to place, but maybe they want, a $10-15 million building. We are constantly picking up buildings for that purpose. And if we don't end up finding the right buyer for an MDO property, we'll actually bundle it and send it out to market as a DST, but we always try to keep a Rolodex of properties available for this MDO program. So that is an option for some of these larger portfolios. If you're dealing with larger exchanges, you're not limited to the DST. There's a lot of different creative ways to go about adding these products in to assist you.
Great.
Mm-hmm. So
very well. So
yes,
you answered my question right here. So if someone wants to get a closer look at this and get some input, Katelen's number's right up there.
Yes. And please, that is my cell phone. You may text, call me, email me, whatever works for you. Don't worry. If you just want some education on things, I do that. I'd say 95% of my job is just educating people on the different various products or helping them, get familiar with the exchange process, or they need accommodator referrals. I'm here for that. Please don't hesitate to reach out.
Great. All right. And we'll make sure to send out her information to you as well after the webinar. I'm not seeing any comments. We may not be hooked up correctly on our streaming platform here. So if you've commented on this while we've been talking, don't worry. We will see those. We will get back to those. We will respond to you. It's just for some reason it's not popping up here on my end.
Too much information. Too much information. They're digesting.
Everyone's just flabbergasted. Yeah, there's too much to take in. Anything else for now, Katelen, that you'd like to cover, or is that it?
You know what? I think that is enough for today for everyone. Again, contact me when you have questions. It takes a couple times sometimes to see these. I have some, follow-up materials if anybody wants them. Contact Dusty, or you'll have my contact information as well. Great.
Well, Katelen, thanks for being on here and taking the time. And if you're watching this, thank you for taking the time as well. I know your time is valuable, and this was, I think we went an hour today. Wow, a lot of information. Let us know if you have any questions. And Katelen, thank you again.
Absolutely. Thank you.
All right. Bye-bye.
Bye.